I'd like to introduce Mr. Marcus Tan, who graduated from Oxford Brookes University, UK, and is a member of the Chartered Tax Institute of Malaysia and a licensed tax practitioner. Of course, right, we are the Tax Policy Forum. With more than 23 years of experience in taxation and specialized in tax advisory involving corporate restructuring and financing, planning for tax efficiency, evaluation and application for tax incentives, stamp duty exemptions, RPGT and CGT advisory, M&A tax and pre-IPO structuring, tax implications for both cross-border and intercompany transactions, and tax audits and dispute resolutions. Marcus speaks regularly at annual post-budget seminars and webinars on tax incentives, tax disputes and resolutions, withholding tax and digital tax, corporate restructuring, and e-invoicing. So Marcus, would you like to start us off, okay. So, then let me go on to introduce Ms. Farah Mosley, who was the former president of the Chartered Institute of Tax from 2019 to 2022, and manages corporate tax engagements covering national and cross-border transactions for MNCs and public companies across various sectors, including services, telecommunications and technology, electronics, infrastructure and utilities, plantations, property development, construction, and manufacturing. She also advises on special government incentives and studies on tax matters and lends insights into government policies for specific sectors. Last but not least, we have Ms. Eunice Hui, who is a chartered accountant and accredited tax advisor with more than 25 years of extensive tax and transfer pricing experience across diverse industries in the Asia-Pac and Middle East regions, including IT, manufacturing, commodity trading, petrochemical, as well as oil and gas industry. And gives strategic tax advice to senior management and stakeholders, particularly in corporate restructuring, complex business models, manufacturing and supply chain arrangements, new business investments, divestments, IP restructuring, cross-border transactions, and employment arrangements. Beyond her corporate role, Eunice also contributes to education as an associate lecturer at local university and private education institutions in Singapore. Right, so with this distinguished panel of speakers, we'd like to call upon Marcus. Would you like to kick us off? Or so with this question of, sorry, the question got mixed up. What role do public and private partnerships and stakeholder engagement play in shaping future tax policies? And how can these collaborations be leveraged to achieve mutually beneficial outcomes?
Right. Thank you, Christine, and good afternoon, everyone. All right. Okay, so the first thing, I think, is always tough to talk after a professor has presented her slides, right? Because she covered some very technical insights into tax policies, right? What I jotted down she mentioned what Lafay curve, things like that, very technical. Okay, so I will cover something very on a more macro level when it comes to the PPP, the public-private partnership, right? Okay, so I want to point out one thing that our Deputy Finance Minister mentioned this morning. She mentioned some words a few times, like collaborate and contribute, collaboration and contribution, right? Yeah, so that somehow made me feel that it's very much in line with this topic about tax policies and how it affect or what PPP can be enhanced, right? Yeah, our YB Lim Wai Ling mentioned that we are looking at the collaboration between the private sector, public sector, right? That can contribute positively to the economy, right? Those are the keywords I noted down on the paper, right? Yeah. Contribute positively to the economy, of course, to the people and to the nation as well. I don't forget that as a whole, right? So I like that, right? That sets the tune when we talk about policy, right? So what is exactly a PPP, right? I mean, for a short introduction about what is PPP for those who would like to know more. It's basically a collaboration, yeah, between the government from the public side and the private sector, right? And what is the objective of it, right? Typically is to achieve a win-win situation, right? Win-win situation. Of course, the government being the policy makers, yeah, they award projects. So when they award projects, and when the award goes to the project owner, the concessionaire, for example, right? They want to achieve something that benefit both sides, right? Of course, to the economy, to the nation, and all, right? So one of the common things that are the features of this PPP is of course financing, right? Because with the PPP, typically you are relieving the government of the financial burden, the debts. You pass on the financing to the private sector. So when private sector takes up the financing, of course, they have their own financing structure to take up the project over the period of the concession, for example. Yeah, yeah. So those are the things. Yeah. So then, and one of the questions there is that how do we look at tax policy in terms of enhancing, right? Enhancing this PPP to be mutually beneficial, right? Yeah. So I believe that when the company have to raise financing for the project, and especially if that project is going to be very capital intensive, for example, it will involve huge financing on their side. They have to raise funds, right? Whether it's through a capital injection, whether it's through a loan or any financing structures, right? Like so they take up the financing, and don't forget they also take up the interest, financing costs, right? Yeah. So I think this is probably the point where if the PPP could be looked at when from a more on of course not from the granting of the award and all that, more from the post granting of the concession to the concession holder, to the project owner, right? What sort of incentive they could be so-called be considered for them? Probably more to the MOF to decide, right? I think this part could be enhanced, right? How we incentivize all these project owners, because don't forget they are bearing the not just taking the loan, financing, they are also bearing the cost, the huge financing costs, right? And if they are taking the financing through their interco structures, let's say a parent getting financing and pass it down to the project owner, being a concessionaire, what will happen? Then you look at transfer pricing, right? You look at transfer pricing perspective, right? Is this an interco transaction? Then that you need to comply with Section 140A. And then the next question is there a dim interest income in that transaction, right? So this is something where the government could perhaps consider granting an exemption for that, maybe, right? Not to say exempt the company from the entire transfer pricing provisions, but in terms of that particular project for financing purposes, those financing are all very much a capital contribution in nature, I would say, right? It's equity, right? You raise capital for the purpose of the project owner to construct, for example, right? So these are very capital, right? You wouldn't want to be caught in a situation, a post-event situation, where you're caught with all these tax issues, where the tax authorities come and do a tax audits, and then you're caught in a situation where interco transactions subject to dim interest income and all that, right? So it's not so positive on that point, right? Well, you want to incentivize them, right? you want to incentivize them on incentives for their infrastructure projects, high capital intensive projects, you may consider income tax exemption, or you may consider investment tax allowance or investment allowance for service project and blah, 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 blah. There's a lot of incentives out there, right? But there are certain tax treatments that they must be considered as well. So that is one point where I feel if the tax policies can also be a bit more positive on this side of, after granting the award to the project owner, and when they apply for incentives, right, it could be looked at perhaps in the more holistic manner, right, not just this on the incentive, to look at what are the other tax treatments that could benefit them as well. Perhaps all this can come under a customized incentive. Okay.
Yeah, thank you so much, Marcus. That's quite enlightening, because usually when we look at a transaction, sometimes we don't really understand the implication, the long-term implications of that transaction, especially when it comes to interco and all. Perhaps, Farah, you can talk to us about the key drivers that are shaping the future direction of tax policies globally, and how do they impact the economic and social landscape?
Very good afternoon, Assalamualaikum, and thank you again, ISI, for this opportunity to be on this stage. I remember 2020 was the first forum. Can't believe 4 years have passed, and I'm privileged here to be with friends across the hall as well. Marcus, whom we've not met for many years, but we've known each other for so long, making new friends. Christine, as well as Eunice, who flew all the way down from Singapore. So I'm looking forward to learn as much as I can. So I put in a stopwatch because I know then that we have the minister doing a closing later. But when we talk about tax policy and reform, I'm always very excited. Almost wanted to jump because I prepared a couple of slides, but I want this to be more of like a brain teaser, something for you to think about as we look at how this country will progress into the next phase. With all the unprecedented challenges that we have faced, COVID, who would know that we'll be faced in a situation where we cannot operate. After that, there was a supply chain issue, geopolitical tension, governments trying to fill in their coffers, revenue and tax or fiscal measures is something that everyone looks at, and more focus on that. So I've got a couple of slides, and I've broken my slides into 4 components or 4 parts. And one of them is the trend, as Christine has mentioned, the trend impacting policy. The second one is international development. We can't run away. I remembered when I first started doing tax 20 over years ago, it was very much domestic. When TP came, it was 2007, right? And it was so much more domestic. But now we're talking about global minimum tax. We're talking about base erosion, profit shifting, countries trying to protect their tax revenue. The third one, I'll be talking, we can't run away from sustainability. Sustainable Development Goals, UN is striving for that. Inequality of wealth, where tax is being used as a measure to try to achieve equality. So the third point is on sustainability, and the fourth point is technology. A lot have been spoken about technology and the technology evolution. Yeah. So the first slide that I have here is on the fiscal policy objectives. Yeah. We can move to the next slide. In terms of 4 drivers that shapes the development of tax policies around the globe. And I break it into 4 because the first one is the fiscal policy objectives in terms of controlling inflation, in terms of increasing revenue tax collection. Datuk Sri Dr. Nizam did mention about revenue collection. I remember those days, tax revenue collection used to be about 80 billion. I remember that number because when I was tracking the number, and that was in 2007 or 2008, it was 80 billion. And now, I was surprised myself, it's almost 200 billion. And the increase from the past year to this year, 2023 to 2024, is 7.4%, and it's higher than our GDP growth. Tax collection has to go higher than GDP growth. So where is the money going to come from? And we're talking about billions here. And also talks about reducing national debts. Yeah, diesel subsidy has been pulled back. More will be pulled back, but tax will continue to be introduced. Yeah. Second one is the compliance with international tax standards, and I'll bring across the one point on the exchange of information. Everything is transparent. What you buy yesterday will be known. The taxman will know what you did yesterday. Sounds like sounds scary, but it's not something to be scared of, because, as you know, with e-invoicing, data is at the fingertips. Whatever that you buy, whatever you purchase, whatever you do, information will be in real time. And I take what, I have to quote Dr. Sri Dr. Nizam, because he spoke about compliance by design. I remember he used to mention that. Compliance by design meaning when you pay, when you buy something, you get a tax deduction immediately. When you receive your income is being taxed automatically. So that is compliance, not just with local standards, but now with international tax standards. The third is social and political goals. And I use this word, the economic growth, social impact, where tax fiscal measures is used to influence social behavior and social impact, as well as political. Every new political person who comes in will try to do or will attempt to do a tax reform in some form or other. That's why you hear from the previous speakers a whole host of new taxes, not just in Malaysia, but everywhere in the world. And the third, and the fourth, last would be the tax administration advancement. You hear about e-invoicing, and that's one of the digitalization or making tax compliance more easy, simple, and transparent for all. Yep, in my next slide, what I'll do is I'll cover the international tax policy development, and you can see around the region, Asia Pacific, Europe, EMEA, Americas, all the different actions that's been taken. We are not just alone. You can see all the other respective all over the world. Each country is actually implementing new measures, but you can see at the bottom in the box, the commonality is the adoption and domestic implementation of base erosion profit shifting, Pillar 2, which I think Eunice will cover a little bit, and also the introduction of incentives and taxes. There's pressure. It's a competitive environment. Everyone wants to bring in investments into their country. So that is what each country is doing. As well as you hear earlier this morning, CEO of RB did mention increase in tax compliance on some of those few areas. So something to be on the lookout for. And just touching a bit on Pillar 2 implementation, which I think is important for everyone to be aware of, although it's only impacting large corporations, businesses above 750 million threshold. In the next slide, you can see then that globally, in next slide, globally, many countries have already implemented, and Malaysia will be implementing it in 2025. So the currently threshold is 750 million euro, which is about 3.4, 3.5 billion ringgit. But my crystal ball is saying that number will go down, right? And soon everyone will be impacted. So don't think that this is something that will not impact me. It will come to you. It's akan datang kind of situation. Yep. Next is the key incentives across the region, and these are some of the incentive actions taken by ASEAN countries in response to Pillar 2. It doesn't mean that your tax incentives will end. Marcus mentioned about tax incentives, PPP, partnership with the private sector, etc. But with each country trying to attract investment, and as the world is becoming more and more competitive, you will see a lot of pressure to not just give incentives, but grants, tax credits, all that will become more common. And countries who have a lot of cash, maybe like Singapore, Eunice, they will be able to give maybe more grants. But like Malaysia, for example, can we afford grants? Can we afford credits? So what are the alternatives? And I move on to the third component, which is sustainability. And I must talk about sustainability because I'm a proponent of sustainable actions, because we live in this world, but we must leave this world in a better place for our next generation. So in the next slide, you can see then that the tax policy development takes into consideration sustainability incentives, carbon taxes, carbon incentives, carbon credits. Just now over lunch, someone was asking me about what do you think of carbon credits. Have we really thought about it? I know MOF is already designing something, or thinking of it, but if you can see around the region, there are 70 plus carbon regimes. Yeah, and you can also see all this has got interaction with Pillar 2, base erosion, profit shifting. Everyone wants to protect their own tax. Yeah, and there are 3,000 plus green taxes. Can you imagine? 3,000 plus plastic taxes, recycling waste, landfill tax, a lot of green taxes. Yeah. In the next slide that I have here is digitalization. This is the last component. You can see the advancement of tax administration and digitalization. You can see this on one hand is to reduce burdens on taxpayers, real-time reporting. You know, you don't have to submit your tax return. People like me, maybe Marcus, have got to cari makan, right? Because, you know, you don't need to complete your tax returns anymore. And on the left side is supporting taxpayers on compliance. How do you comply with the complicated tax rules and regulations? What best other than to use technology? Yeah. And you can see also the global, in the next slide, global digital transformation, trends of tax administration. We are not alone. If we think that e-invoicing is actually difficult, short of time, we need extension of time, we need exemption, we are not the only country. Across the world, each country, each government authority is already designing something along digitalization of the tax administration process, as you can see in this slide. And this is just and in the next slide, you can see where the whole world is going. We are going towards level of ESS, where tax returns need not be filed. Everything will be real time. The moment you go and buy a book, you get an automatic tax deduction, right? But where we are now, as a country in Malaysia, we are probably at level 2, e-accounting, or probably at level 3, e-match, yeah? So with that, just some food for thoughts, and I hand over back to Christine.
Thank you very much, Farah. That was very informative. With that said, I'd like to call upon actually Ms. Eunice Hui to talk about, to answer the questions on potential risks and benefits of implementing a global minimum corporate tax rate, yeah, and how might it impact MNCs operating in Malaysia, and also how you foresee the interaction between OECD's BEPS 2.0 initiative. Yeah, okay.
Yep. Can I have my slide, please? Yep. Turn on to the next slide. Okay, I'm pleased to be here today to discuss about the OECD, the two-pillar approach in addressing the base erosion and profit shifting issue. So my focus will be on the Pillar 2 implementation in the context of Malaysia. So firstly, let's basically just talk through about Pillar 1. So this Pillar 1, right, basically focus on the reallocation of the taxing right to market jurisdiction where MNCs, right, have a significant consumer-facing activity. That being said, right, what it simply means is that this market jurisdiction will receive a fair share of the tax revenue reflecting the economic activity that take place within their borders. Now let me turn to the next page, focus our attention on Pillar 2, which introduces a global minimum tax rate of 15%. In this case, the Pillar 2 emphasize and to ensure that the multinational company only pay a minimum rate regardless where they are headquartered or regardless where they are operating. The underlying principle is to prevent profit shifting to low tax jurisdiction and to also curb the tax competition among the countries. So over the years, that is what we know, Singapore, Malaysia are no exception. Many countries actually have been engaging in tax competition by lowering our actually corporate tax rate in order to attract foreign direct investment. This actually gives rise to what we call the race to the bottom phenomenon. It has led many organizations to shift their profits, right, from a high tax regime to a low tax regime. Often, right, this country, they only have a very minimal economic activity in this country. In addressing this phenomenon, the race to the bottom phenomenon, what the OECD has done is to propose the introduction of a global minimum tax, in short, the GMT, as part of its BEPS initiative. This GMT ensures, right, that the multinational company only pay a minimum level of tax irrespective of their headquarters or operation. So the next slide. Okay, so on this slide, right, it shows us where does it apply in the context of Malaysia. You only apply, as what Farah mentioned, right? You must meet the total yearly group revenue threshold amounting to euro 750 million. And also operating, this MNC must operate in at least 2 jurisdictions. So in the Malaysia context, right, this GMT will apply to two basically a Malaysian-based MNC with foreign operation outside of Malaysia, as well as you also apply to foreign-based MNC with operation within Malaysia. Next, we need to understand, in order to understand the impact, right, of the GMT on the multinational company operating in Malaysia, we need to first take a look at the current tax environment in Malaysia. So the next slide, please. Presently in Malaysia, the prevailing tax rate is 24%, which is above the OECD proposed GMT rate at 15%. However, like what Farah and also Marcus mentioned, Malaysia offers a variety of tax incentive and exemption, particularly targeting a certain industry and activity. That means that this incentive could potentially reduce the effective tax rate of this global MMC below the global minimum tax rate of 15% in some cases. As far as we know, Malaysia tax incentives are designed to attract foreign direct investment, to stimulate economic growth, and also to protect certain key industry, especially in the manufacturing sector and also in the technology space. Yet, right, if you look at these two framework, okay, the incentive versus the GTM framework, it seems that the Malaysian tax incentive may be at odds with the principle underlying the GMT, which aims to actually curb profit shifting and tax-based erosion. So what are the potential impact? My next slide, please. There are positive outcomes, the good ones and the bad ones. Okay, let us discuss some of the positive outcomes that could potentially lead to arising from the implementation of the GTM. So firstly, by establishing a floor rate on the corporate tax at 15%, GMT actually aims to reduce the harmful tax competition among the countries, reducing the race to the bottom phenomenon. This initiative also creates a more level playing field for multinational companies operating in Malaysia, ensuring that tax regime do not overshadow the general economic activities. It also promotes a healthier, competitive environment where the business can grow, expand, based on the inherent strength rather than relying on tax advantages alone. Secondly, is to level the playing field. So GMT reduces the incentive for MNC to shift the profit from a high tax regime to a low tax jurisdiction, ensuring they pay a fair share of taxes in these countries where they operate their profits, including Malaysia. So this can lead to increase in tax revenue for Malaysia, which can be reinvested for multi-purposes in the public services, in the infrastructure, as well as economic development activity. Thirdly, by reducing the incentive of profit shifting, GMT also encourages business to focus mainly on general economic activity rather than tax-driven decision. So from the standpoint of the businesses, right, this GMT actually will force the businesses to make sure that they allocate resources, right, enhancing overall growth and productivity. Let's focus on tax reasons. Another positive outcome is that because of the global nature of the GMT, it promotes greater cooperation between the tax authority worldwide. And this collaboration can reduce tax competition among the authorities and promoting economic stability and growth. And in the context of Malaysia, of course, it will mean that Malaysia will strengthen international partnership and create a more conducive tax environment by introducing this minimum global tax rate of 15%. The implementation of GMT, like I mentioned at the outset, right, it does lead to some challenges as well. Some of these challenges will include the bad one, okay, it will raise up the complexity and also the compliance cost, both for the taxpayer as well as for the tax authority. Tax authority in Malaysia will face greater administrative burden to enforce these new rules and also resolving dispute. On the other hand, the MNC will need to invest in new system to track down their effective tax rate. So with the increasing tax burden, there's always a risk, of double taxation. Reason because there is different interpretation of the rules, impacting the domestic investment and the economic growth. So the country that have been relying on incentive, granting incentive to investor to attract this investment, may now face a reduction in the foreign direct investment, just like Malaysia, in the case of Malaysia. I wanted to move very quickly to the next slide. How does company get prepared for this GMT implementation? So firstly, the MNC need to reassess and potentially restructure their operation, financing arrangement, and supply chain to make sure that it aligns with the new tax landscape. This may also involve reallocating certain functions and optimizing intra-group transaction to comply with this minimum tax rate. And this MNC must also now evaluate their current tax position and develop new ones to make sure that they mitigate the impact of GMT, especially if they are granted tax incentive. I'll take you a case study in my next few slides. So MNC will also need to make sure they enhance their tax reporting because of the GMT reporting requirement. This will also likely to involve upgrading the system to accurately track and report global income, and also what are the taxes they paid, increasing the compliance burden on the taxpayer. But one last point is that they also need to consider MNC might want to reconsider their investment strategy, potentially relocating their operation to a jurisdiction with more competitive advantages. Then I'll move on to the next slide on transfer pricing, the interaction between the BEPS and the Malaysia transfer pricing existing transfer pricing. Next slide. Okay, I don't think I need to do this quick recap. Move on to we will now turn our focus to transfer pricing. Okay, so transfer pricing is being implemented by Malaysian government to counter the profit shifting and base erosion issue. It is being designed to ensure that the transactions between related parties are conducted at arm's length basis and the profit are correctly allocated to Malaysia. So we would like to discuss what are the potential areas of alignment between these two frameworks, the GDM framework vis-a-vis the TP, existing TP transfer pricing policy, and any likely conflict between these two frameworks. Okay, so in terms of alignment, both the Pillar 2 and the transfer pricing regulation emphasize on the transparency and consistent reporting. So there's now enhanced reporting by the two frameworks. So these will present authority with a clear picture where the profits being generated and how they're being taxed in the various locations. Secondly, there's also an improvement in the tax compliance with the introduction with the global tax policy. We will encourage the company to adopt a more robust transfer pricing strategy as well as documentation practice to avoid the risk of any top-up taxes and penalty. So by ensuring that transfer pricing policies are compliant with both regulations, unfortunately, you can mitigate the risk, but at the same time, you also increase the tax burden, the compliance burden. Okay. Double taxation may arise, because of the different interpretation. So government need to carefully consider how to mitigate this risk through its transfer pricing regulation and bilateral tax treaty to ensure that businesses are not unfairly taxed in the various countries due to the implementation of GTM as well as with the current transfer pricing regulation. I will move very quickly in the interest of time, just to illustrate with an example. Okay. Let's consider this case study involving a Malaysian parent company with manufacturing operation in Malaysia, and also involving a Singapore subsidiary that functions as a regional sales marketing company. In this example, the Malaysian parent company enjoys the investment tax allowance incentive, which reduces its effective tax rate below the statutory corporate rate prevailing at 24%. On the other hand, the Singapore subsidiary had been awarded the Global Trader Program incentive, further reducing its effective tax rate below the global minimum tax rate of 15%. And in this case, the related party transaction is that the Singapore subsidiary purchases finished goods from the Malaysia factory parent company and sell it to third party in the region. So let us look at, with this background, let's look at the key highlights of the case study, which is the next slide. As a Malaysian parent company right now enjoy the investment tax allowance incentive, the effective tax rate will be lower than the statutory corporate rate of 24%. As for the Singapore subsidiary with the Global Trader Program incentive, the effective tax rate will also be lower than the global tax rate, as we mentioned, the 15%. So what will happen potentially is that under the Pillar 2, the Malaysian parent company may be subject to what we call a top-up tax by bringing the effective tax rate to a Singapore subsidiary up to 15%. This means that the Malaysian parent company will have to include the low tax income of the Singapore subsidiary in its taxable income and apply the top-up tax. So effectively, the Malaysian company will be subject to another layer of tax, okay, another layer, despite the Singapore entity is enjoying tax incentive, but you will be nullified because of the additional tax, top-up tax that have been paid by the Malaysian parent. So with this interaction of the BEPS, Pillar 2 and Malaysian transfer pricing regulation, it presents a lot of challenges and also opportunity. So now the question is, how does the MMC get prepared and what we need to focus on next? Next slide, please. So what are the next steps that must be undertaken by the group, the Malaysian parent and the Singapore subsidiary as a group? They must reassess the sustainability of its current tax strategy in light of the Pillar 2 rules and explore any other alternative that may not trigger the top-up taxes. The group also should assess the global tax position and ensuring that it can identify jurisdiction where the effective tax rate are below the 15% threshold. Secondly, the company should also review their transfer pricing policy, whether or not it's defendable against this position that they're taking now. They must align with the OECD transfer pricing and also the Pillar 2. Okay? We need to revisit the pricing of the intercompany transaction, ensuring that the profits are correctly allocated to the jurisdiction with higher tax rate now. And what is really important is that the group, right, must actually establish very robust tax governance framework to make sure that it complies with all the rules and regulations, not only with GMT implementation, but at the same time, okay, you also must comply with the existing transfer pricing rules. One alternative, right, which hardly I see in my context, right, that people will consider is applying for an APA, Advanced Pricing Arrangement. So to mitigate all this transfer pricing risk and issue, the company may consider seeking an APA in advance with the authority in Malaysia and Singapore. Because under the APA, it gives a lot of certainty on your transfer pricing methodology being applied to the intercompany policy. Okay, that ends my presentation.
Thank you very much for very clear example. I'd like to actually now redirect back to Marcus and for you to talk about how can tax policies incentivize corporate social responsibility and encourage businesses to contribute positively to society beyond their tax obligations?
CSR. Okay, CSR question. Normally I will look at it from a broader context. Now we call it the ESG, environmental social governance perspective, right? CSR is very much linked to it. Okay, so the question is about how do we incentivize, right? You know, the taxpayers or beyond their normal tax obligation. Well, you see, the taxpayers can be in the form of corporations, individuals, right? So how do they contribute, right? Say for companies, the government have been thinking about how to incentivize companies or SMEs or even smaller SMEs, micro SMEs. They have announced incentives for them, tax deductions for them. The more recent one, which was announced in the 2024 budget, was the tax deduction up to 50,000 ringgit per annum, per year assessment, right, for governance-related expenditure, right, that are incurred by the MSME. Invoicing costs, for example, you get that tax deduction. Transfer pricing costs was another example. There are other ESG-related costs, tax corporate governance, right? Yeah, so I think the government have been focusing on these aspects, right? Perhaps more can be looked at towards how we could incentivize more of the people on the street. From of course CSR perspective, right? You want to encourage people to make donation for charities. Yes, you get reliefs, right? You get reliefs for donations made, right? And that has been around for a long time, right? How could we enhance those tax relief that is linked to CSR, ESG focus, right? Which then you can encourage more people to then get involved, be more proactive in terms of CSR initiatives, whether from a personal level, not necessarily must be driven from a company level. A lot of people are focusing on this more from a company level because, oh, my company is involved in this project, I'm involved. The companies gets incentives, for example. What about from a personal level? Right? Things like EV cars and all that, yeah? But there are more to that, I think. Yeah? This is one area that I think it could be explored and enhanced, right? And from a personal tax relief, which will really impact the taxpayers when they file tax returns, they could get more tax reliefs from their CSR expenditure, right? This will mean more, lesser taxes, of course, but more disposable income in the end for them to spend. Right? That is a more positive way, I would say, right? Other than their year to year, they file tax returns, file tax, and those reliefs are, more or less, or yeah. So I think that is one part, and there is another thing about invoicing that we talk about. This will be the quick one, invoicing. I think invoicing also impact individuals who do businesses, right? Not just companies. Yeah. So you could also play a role from that perspective, right? Getting yourself to be compliant with invoicing requirements. If you do business, of course, there are exemptions for individuals who don't do business. You don't have to issue e-invoice, but these are the things that people should start thinking, right? People on the street will start thinking, if I do a business and I try not to call it a business and I avoid being subject to invoicing, for example. These are the things, right? So are you contributing to from a social perspective by avoiding? Question,
Food
right?
for thought.
Food for thought, right? Yeah, over to you.
Yeah. Thank you very much, Marcus. Farah, would you like to chime in a little bit on that?
Yeah, when you talk about ESG, UN has the Sustainable Development Goals. Government, as what Marcus is saying, is actually trying to introduce measures to, in a way, when you talk about ESG, is to also equalize income distribution. And tax is one of the mechanisms to try to achieve that. But the one thing that, and this is just food for thoughts, and this is a topic on tax policy and how it will shape the economy, impact to the society, as well as the future that we want to achieve as a country. But when we talk about distribution of income, taxing the rich, and this may be a bit sensitive maybe to some, introducing wealth taxes, you hear about high value goods tax, and this is just my own personal view. My own personal view, not EY's view, it's just Farah's 2 cents of thought that I have here. It's okay to tax the rich, to equalize income and redistribute it back to the less fortunate. But at the same time, the one other equation that we need to achieve is how do we make sure that the rich or the wealthy continue to contribute back to the economy. Wealth is mobile. Just like businesses, they can choose where they want to invest in. Country that provides incentive, maybe I'll go there. Cost that is low, they will go to low cost jurisdiction. Right? Same goes with wealth. You tax the wealth. And I just read in a news article that in Norway, when they start to increase the tax, 0.95% of wealth tax to 1%, and there's just a mere 0.05%, they had the rich uprooting and starting to invest their money outside of Norway. So that's something that we need to think, because we want them to continue to contribute to the country and continue to distribute wealth in the country and invest. And that's something that we want to take. And I've seen the coming trends whereby there are many jurisdictions who are trying to attract high net worth individuals. Singapore is one of them. And there are also many countries who are trying to attract big corporations who could invest a lot, or startups, the unicorns, and name it, those kind of businesses. Yeah.
Thank you very much, Farah. Now I'd like to open the question to the floor.
Sorry, before that,
Yes.
can I just contribute some comments,
Please.
about e-invoicing? Okay, I believe e-invoicing will not only impact, right, taxpayer with commercial activity, it will also impact people like you and me, individual. Why I say that is because generally in the first instance, right, we always think that only taxpayer undertaking commercial activity need to comply with e-invoicing, but that's not the case only. Reason being that if today you walk in to buy luxury goods, right, government don't have much information about the consumer, because the luxury goods store doesn't collect enough information about the person who walked into the shop and purchased a luxury good, doesn't collect information. But now that with this invoicing, what will potentially happen is that they will collect a lot of information about the consumer who purchased this luxury good from a retail shop, proper retail shop. So the information being captured is your name, who's the one who buy it, and then over the IRB system, right, they also can trace back how much income do you have. So assuming, right, on a year-to-year basis, right, you will generate an income of ringgit, right, assuming it's 500,000 and 500K. But you will always purchase, right, goods, right, luxury goods, right, above 500K, okay, above your annual income. So you will trigger off some questions from the IRB, where is the source of income? Because now government can trace back through e-invoicing. Everything can be traced now.
Yeah, that's kind of opening up Pandora's box. Yeah, but that's so true. That's so true, because now all your information is there. The IRB has all your information. Yeah. Okay, does anyone have any questions on the top of their mind to ask? Whether it's on e-invoicing or on sustainability or the future trends on tax policies. no questions, then we can take one more question. I'd like to address this question to Farah about the specific measures that can be implemented to address the challenges of taxing digital transactions and ensuring a level playing field for traditional and digital businesses.
The world has changed now. We used to talk about brick and mortars. You see a transaction, you tax a transaction. But these days, transaction is occurring as we sleep. Bitcoin, the question of how do you tax it? That's why you see the emerging trend of capital gains, and businesses and governments trying to actually introduce, even like Malaysia, we brought back, maybe not the word brought back, but extend the scope of capital gains to include not just property, but also to tax capital gains that's been made through this kind of digital transactions. And there are complexities surrounding it, and we heard also this morning the taxing of digital services or importation of services, and all that is now being brought into the tax bracket. It will continue to be evolving. That's my view of the next coming 5-10 years, and it's going to be evolving so quickly and so fast that we'll see the word emerging will soon become the common word, right? It's no longer emerging, it just becomes the common thing that we see. But the food for thought, or the thing that we need to look at, is sustainability, right? How do we sustain the revenue collection back then, when our tax revenue if I take 2008, 2007, it was in the 90s, 99, it was 28%. I remember that. You Marcus remember that too. Tax collection was 80 billion. Now our tax rate is 24%, and there's a push to reduce it further, but our tax collection is almost 200 billion. So there will continue to be pressure to collect additional taxes, but to reduce tax, and there will be new mechanism to try to tax the unknown, which includes digital economy plus shadow economy.
Thank you very much, Farah. Marcus,
if I can add on to what Farah has mentioned, I think it's very important to look at long-term sustainability. Yeah, when we focus on tax policy, right? We need strong political will, yeah, to drive that tax reform or tax policy innovation, you call it, right? The fruits of tax policy innovation, as you see today, the earlier speakers have shared about all sorts of various taxes that came recently. Right, capital gains tax, right, high value goods tax, low value goods tax, or those taxes that are about to be introduced soon. Yeah, global minimum tax, effective 1st January 2025. Right. Yeah, I think the government is striving to innovate or to think what other taxes they can bring in to increase tax collection. Right. But I think Professor mentioned something very important earlier. Right, while you want to increase tax collection, you are driving the innovation, the tax reform, right? End of the day, is it efficient? Right? Is there productivity enhancement? You see, right? So we heard that, yeah, GST is a better system, right? Because it's more efficient, right? You don't have cascading tax effect like the SST. You don't add additional business costs to companies. Things like that, yeah, we know, right? You need that kind of strong, right, will to drive through all this tax reform. Yeah, it's not easy, but I think that will be the future. I feel, right? Starting with invoicing as a precursor. I feel before GST come in the near future, which is, of course, everybody acknowledge that to be a better system.
Yeah. Thank you very much, Marcus. It's also like time-tested. Political will is one thing, but it's also time to test it through, yeah, to fine-tune and refine the systems. I heard some murmurs on the floor just now. Was there a question that is on the tip of your tongue that wants to come out? At the back, anyone? Before we end this session and you lose the opportunity to tap into these brilliant minds? No more? Okay, if that's the case, then I'd like to thank all three panelists. Thank you for a very informative, enlightening session. And I hope that all of you have gained a lot of insights from today's discussion from the morning right up to now. I'd like to pass back to the MC.